Welcome to Course 2 of Module 2 on put options. While a call option is ideal to capture large bullish moves, a put option is the ultimate protector of your portfolio. It's also great to capture profits when markets or stocks are making bearish moves to the downside. This is the course agenda. We'll start with a recap of call options. If you're viewing this presentation first without watching the call options presentation, I recommend you stop right now and watch the call options first. The call options course was the introduction to options, so many of the fundamental options concepts are covered in that course. After doing a recap, we'll define what a put option is, and you'll realize it's just the opposite of a call option. Just as we did in call options, we'll look at a real-world concept that will help us understand the concept of put options. Fortunately, we have excellent examples of put options in real life. Finally, we'll look at real put options in the market using Apple options. We'll then look at 3 scenarios for put options on Apple and study the buyer-seller perspectives as well as the profit and loss scenarios on expiry. We saw that the call option gives the option buyer a right to buy. We used the example of a real estate deal and saw that by buying a call option, the buyer could have profited very big if the price of the underlying asset, which was the land in that case, went up by a lot. The buyer paid a premium for this call option, and therefore his break-even price was the strike price of $1 million plus the premium of $25,000, which was the at-the-money option. The buyer needed the price of the land to go higher than this amount to make a profit. Let's now define a put option. The holder or buyer of a put option has the right to sell a certain underlying asset at an agreed upon price, which is the strike price, by a certain date, which is the expiry date. It's simply the reverse of a call option. In a call option, the buyer of the option had the right to buy a certain asset. And in the case of a put option, the buyer of a put option has the right to sell a certain asset. And the seller of a put option is obligated to buy the stock at a certain price. So again, from a seller's perspective, you should notice that it's exactly the opposite. In the call option example, the seller of the call option had an obligation to sell, and in this case, in the put option, the seller has an obligation to buy. So you should be able to imagine right away that if a stock falls sharply in value, and if you have a put option on that stock, you can still sell the stock at the option strike price, which may be much higher than its current price now. This is how put options make money even when stocks go down, but you have to be the option buyer and not the seller. A put option is the reverse of a call option. A put option buyer can make a very large profit if the price of the underlying asset goes down. And just like the call option, you need a seller of the put option who is willing to sell you this option. As an option buyer, once again, you have rights, and as an option seller has obligations. Your rights as a put buyer is a right to sell the stock at a certain strike price of the option. Simplistically speaking, if you bought a put option for Apple at $525 and Apple went down to $400, you could still sell your Apple shares at $525. So something may be confusing here, and many newcomers to options have an understanding problem with this part. You're an option buyer, and by buying the put option, you have a right to sell the underlying shares. Or let me state it a little differently. There's 2 different securities involved. One is the option and one is the shares of stock. By buying the option, you have the right to sell the shares in the case of a put option. Now, you do not need to own the shares, as you can always sell your option anytime in the market before expiry. Once we look at real put options on the trading platform, these principles will become a lot more clearer. This slide compares call options and put options, so we can see how a put option is exactly the opposite of a call option. A call option is a right to buy, and a put option is a right to sell. A call option is considered to be a bullish position when viewed from the perspective of the buyer, and a put option is a bearish position when viewed from the perspective of the buyer itself. In case of a call option, your break-even price is the strike price plus the premium that you paid. And in the put options, it's the opposite. The break-even price is the strike price minus the premium, and we'll see this in our examples. In the case of a call option, the stock must move up for the option to become profitable. And in the case of a put option, the stock must move down for the option to become profitable. In the case of a call option, an option is in the money when the stock price goes higher than the strike price. So which means the stock has already crossed the strike price and is higher than the strike price. So if we recalled our land example, if the value of the land went from $1 million up to say $1,020,000, then that call option is in the money by $20,000. In the case of a put option, it's the reverse. A put option is in the money when the strike price is more than the stock price. So which means that the stock has already fallen below the strike price and is lower than the strike price. So we'll see all of this in action, but you have to understand that put options are exactly the opposite of call options. We now recap the four main factors that affect option pricing, and these don't change whether you're talking about a call option or a put option. They are the current price of the underlying asset or stock, the strike price of the option, or what we're really talking about is how far is the current price of the stock from the strike price of the option. Then we have volatility of the underlying, and we have time to expiry. None of these change. They are exactly the same as in call options. And like in call options, the two smaller factors are ignored, although they are inputted into various options pricing models. Again, the basic concept of put options is also best described by a real-world example. In the case of put options, fortunately, we have several real-world examples which most of us have experienced. It's called insurance. When we buy insurance, we are actually buying a put option on the asset that we are covering. If we buy car insurance, we are buying a put option on our car. If we buy home insurance, we are buying a put option on our home. And if we buy life insurance, we are buying a put option on our life. If the car gets totaled, its value goes down to zero. However, since we bought a put option, we get paid the fair value or the blue book value of the car. This is the most simplistic example we can think of when we try to understand a put option. The premium that we pay to the insurance company is our maximum loss, because anything beyond that, the car is covered and the insurance company bears the risk of damage. The strike price is the current value or the blue book value of your car. Expiry is generally a 1-year policy, after which you buy a new put option. So whenever you think of put options, think of insurance. The insurance is the best example of a put option in real life. The insurance company is the seller of the put option, and you are the buyer of the put option. The maximum the insurance company can hope to gain in this transaction is the premium that they receive for insuring your car. However, they are exposed to larger losses if the value of your car goes down due to an accident. And this is exactly like the seller of the call option, where the maximum the seller could hope to gain was the premium they received from the buyer of the call option. The insurance company sells you the option and they hope that the value of the car does not go below the strike price due to an accident. Again, we are talking about this from a strictly financial standpoint. If it goes below that value, then they pay for fixing it. And again, this is a concept. So there are things like deductibles, etc., which we don't consider in our example. Let's consider the case of our car. We buy a car for $20,000. Now the car then becomes the underlying asset. We pay an insurance premium of $1,000 for 1 year. The car is insured for $20,000, which then becomes the at-the-money strike price of this put option. If the car is totaled, its value goes down to zero, but because you've bought a put option, the insurance company will reimburse you the $20,000. So this is exactly like you having a put option and you had the right to sell that put option at $20,000 even though the price of that asset went down to zero. So this is going to be very similar in our stock examples also. So this is an at-the-money put option, which is a right to sell the asset at a certain price depending upon what the strike price of that option is. Let's look at the details of this particular put option. The buyer has the right to sell the option at a strike price of $20,000. The buyer paid a premium of $1,000 to acquire this right. The seller has an obligation to buy this asset at the strike price of $20,000 if something goes wrong. Expiry of this option is 1 year. If the buyer does not exercise his right, then the seller keeps the premium. In our case, this statement can be a little twisted because in the case of a car insurance, you don't actually exercise your right, but if you do have an accident, then you can exercise your right. So the buyer loses this premium of $1,000 regardless of what happens. So now we've created a put option on the underlying asset, which is the car. The current price is $20,000. The strike price is also $20,000, which is the blue book value of the car. So this is an at-the-money put option at the strike price of $20,000. When people buy insurance, they don't think of it as buying a put option, but we think of it as protection. And this is very key, and it's very important for us to understand that protection is a key characteristic of put options and why they are so important in options. So let's say it again. Protection is a key aspect of put options. If you have 100 shares of any stock, say Google, one put option will protect those 100 shares from a catastrophic fall in price, even if it falls from 600 to 200. And why one put option will do it? That's because each option contract is 100 shares. So if you own 100 shares of Google, you can protect that stock with one put option. So buying this put option obviously costs a little money, just like buying any protection, any insurance will cost you a little money. But this money is not much. So buying put options is like buying insurance, and selling put options is you are the insurance company. You pick up the premiums, but you assume the risk of large loss. So you may be asking again, why on earth would somebody be selling put options? And why on earth would somebody be selling insurance? Well, before we answer that question, think of it this way. Insurance companies are some of the largest companies in the world and have the biggest financial assets of all kinds of companies. They would not be so big if their model did not work. And in the world of put options, you'll also learn that selling options can and is a very viable path for success. But this will have to wait for now because we have to cover various other topics first. Because the assumption of risk, selling options become a more complex strategy, and we'll be covering it in the next module. Let's now look at the buyer and seller perspectives. The buyer of the put option wants the stock to go down. His put option will increase in value and he can sell it for a higher price than what he bought it for. If the stock goes below the strike price, his option is said to be in the money, but it must also go down by an amount of what he paid for the option. The option buyer's loss is limited to the premium that he paid for the option. So if he's wrong and the stock goes up, the maximum he can lose is the price he paid for this option. There's one difference between a call option and a put option in the maximum profit and maximum losses calculations. In a call, the theoretical maximum profit for a buyer of the call option was unlimited because technically the stock could keep going higher. In the case of a put option, the maximum profit can be very large, but it cannot be unlimited because the lowest that a stock can go to is 0. Likewise, the maximum loss for the seller of a put option is also not unlimited. It could be very large, however, if the stock keeps going down and goes towards 0. Think of the insurance company for your car. The maximum they are liable for is if your car goes down to 0. Just like call options, put options also have at the money, in the money, and out of the money options, and the best way to look at these is with stock examples. But before we do that, let's look at the profit and loss profile for a put buyer. And again, if you recall the call option example, you'll see the put option is a mirror image but on a different axis. The call option had unlimited profits on the upside, so which was on the right hand side, whereas in the put option you have very large profits on the left hand side. So again, if you look at the axis, we have the x-axis, and x-axis is the strike price or the share price or the price of the asset. So we have 0 in the left and we have 20K. The dotted line is the strike price, and in the case of our car, that strike price is going to be $20,000. And anything below $20,000, the put option buyer has a profit. So again, we're looking at the dark black line, and since the option buyer paid $1,000 for as premium, anything below the value of $19,000, when you look at it from a financial standpoint, if the value of your car goes below $19,000 for obviously if there is an accident, then the insurance company will have to pay you to fix it. So that's how we look at put options, and as the stock price keeps going down and approaches 0, your put option is going to increase in value and your profits will also increase in value. And then now if you look at the y-axis, we have the 0 line again, and anything below the 0 line is your losses. So the maximum a put option buyer can lose is the premium that they pay, and that's why you see the horizontal line which flattens out at the amount of the premium that they paid to buy the put option. So this is a P&L diagram from the view of a put buyer. Let's look at a put seller. The put seller is obviously going to be the reverse of a put buyer. And the maximum profit that a put seller can have is if the stock stays flat or if it goes up in value. But the maximum profit is capped, and that's equal to the premium that they received. And if the asset goes down in value, then the put seller begins to lose money. So that's the P&L profiles for both the buyer and the seller. They have opposite profiles, and then once you start seeing more of these diagrams, you'll see how the four P&L diagrams are correlated. The put side is going to be a mirror image on a different axis, and the buyer and the seller always have opposite profiles for either a call option or a put option. Again, all of this will become much more clearer when we go to the real trading platform. Finally, we are going to come to the expiry and settlement obligations. These are again the same as for the call options. Both buyer and seller must close their positions. Closing their positions can be done by exercising or by cash, and this is obviously in a real options market. All extrinsic value will go to zero at the time of expiry, and if the put option is in the money, it will have some intrinsic value. Buyer can sell this option and capture this intrinsic value. So if a buyer wanted to exercise his option at 525, then the seller is obligated to buy those shares at 525. We are talking about the Apple example where Apple went down to $400. And both buyer and seller can close their positions at any time. So for this chapter, we're going to do a summary of the put options. And just like we did in the call options, we have two more chapters in this course. One will be examining the put options from a buyer's perspective, and chapter 3 will be summary of put options from a seller's perspective. So a put option gives the buyer the right to sell the stock, and the seller has the obligation to buy the stock. The buyer pays premium for this right, and his profits are unlimited or very large because the stock can go to a maximum of zero on the downside. However, the buyer's losses are limited, but the stock must move in a bearish direction to make profit. The seller, on the other hand, receives a premium, and his profit is limited to this premium. But his losses are unlimited up to a limit of zero. The stock can remain flat or go bullish from the perspective of the seller. Let's now go into chapter 2, where we look at real put options using the Apple examples, and we'll see how put options are structured on a trading platform, and this can be a little tricky, and definitely for newcomers you'll have a little problem understanding the layout of the option screen when it comes to put options and exactly how in the money, at the money, and out of the money options are structured. So we're going to explain all of that in detail. So I'll see you in chapter 2.